Most people in the US know they have a credit score. Very few understand how it really works. A lower score makes cars, homes, and even insurance more expensive. The surprising part is the score isn't about being rich. It's about being predictable. Here's how credit scores work. A credit score is a number between 300 and 850 that measures how likely someone is to repay borrowed money. Banks don't know you personally, so the score helps them judge risk. It's a prediction tool. In the US, most lenders still use FICO, although Vantage score exists too. Think of it like a trust meter. The higher the score, the cheaper it is to borrow money. With a lower score, lenders charge more interest to protect themselves. Two people can buy the same car and pay completely different amounts over time, just because of their scores. 5 main factors make up a FICO score. The biggest factor is payment history. This is 35% of the score. Lenders want to know if you pay your bills on time. Late payments, charge-offs, and collections hit this part hard. The second factor is credit utilization. It accounts for 30%. Utilization means how much of your available credit you're using. If you have a $10,000 limit and you're using $3,000, your utilization is 30%. Lower is better. The third factor is the age of your credit. Lenders like seeing long histories because it shows patterns. This category makes up 15% of the score. Someone with 10 years of credit history looks more predictable than someone with 6 months. The fourth factor is credit mix. This is 10%. A mix can include credit cards, auto loans, and mortgages. Having different types doesn't guarantee a high score, but it helps lenders see you can manage more than one kind of obligation. The fifth factor is new credit. This also makes up 10%. Opening multiple accounts in a short time creates risk because lenders don't know how you'll handle the new debt. Hard inquiries can cause short-term dips, but they aren't permanent. When you add it all up, you get a credit score. Payment history and utilization alone make up 65% of it. That's why missing payments or maxing out cards hurts so much more than other things. A good credit score can save real money. Higher scores get lower interest rates, which means cheaper loans. Over a mortgage, the difference between a 620 score and a 760 score can add up to tens of thousands of dollars. Your score affects more than loans. Some landlords check it for rentals. Some insurers use it to price premiums. Companies want predictable customers because predictable customers cost less. A few common myths confuse people. Myth 1. You need to carry a balance to build your score. You don't. Paying in full works fine. Myth 2. Income affects your score. It doesn't. You can earn a lot and still have a bad score. Myth 3. Checking your own score hurts your score. It doesn't. With modern tools, soft checks don't affect anything. Hard checks from new applications are the ones that matter. If your score needs help, focus on the biggest levers. Pay on time. Keep utilization under 30%. Don't open random accounts and avoid closing your oldest card unless you have a real reason. Improving your score is slow but predictable. It's not about tricks. It's about consistency. If you found this helpful, the next video explains how lenders think and how to build credit from scratch.